Welcome to the SafeSimpleSound podcast, where we believe that true financial clarity comes from resolving the contradictions families face, not ignoring them. We are here to help you navigate the intersection of wealth and life with a approach that prioritizes safety, simplicity, and soundness. In today's episode, we are continuing our series on risk. If you joined us for our previous episode, you know that through our Safe Simple Sound practice, we redefined risk not as danger, but as deviation. Today, we are moving from the concept of risk to the reality of the environment we live in. We are exploring the storms you cannot control, what the financial industry calls systematic risk. This discussion draws directly from our recent blog post titled "The Storms You Can't Control," which addresses a fundamental tension many investors feel: the desire for total control in an uncontrollable world. To begin, we want you to use your imagination. Picture a ship captain. This captain is diligent. He is disciplined. He has spent years building the strongest hull possible. He has hired the most experienced crew. He has mapped out the perfect route. From a Safe Simple Sound perspective, he has done everything right regarding the things he can control. But here is the catch. No matter how strong the hull is, and no matter how skilled the crew is, that captain cannot stop a hurricane from forming in the Atlantic. He cannot legislate the waves to be calm. He cannot negotiate with the wind. In the world of financial planning, the hull of the ship is your personal choices, your savings rate, your debt management, your budget. But the weather? The weather is the economy. This brings us to the core concept of today's episode: systematic risk. Systematic risk is the risk inherent to the entire economic system. It is the tide that affects every ship, regardless of how well it is built. It impacts the good companies and the bad ones alike. It affects the conservative saver and the aggressive investor. Through our framework development at Safe Simple Sound, we often see families expending tremendous emotional energy trying to predict the weather. They watch the news, they track the Federal Reserve, they worry about the next election. They are trying to control the uncontrollable. The S3 philosophy offers a different path. It suggests a shift in focus. We do not waste energy trying to control the weather. Instead, we focus on building the arc. Whether you are approaching retirement and feeling vulnerable to market drops, or you are in your accumulation years trying to build wealth, this episode is designed to give you a specific tool, the Prime framework, to identify which storms are threatening your financial house and how to stand firm when the rain starts to fall. Let's dig into the foundation of this problem. In our practice, drawing from our CAFC background, we frequently encounter a very specific misunderstanding about how safety works in investing. We call this the stock picker's fallacy. It usually sounds something like this: I don't need to worry about the market crashing because I only own good, solid companies. I own blue chip stocks. I own companies that make things people need, so I won't lose money. This sentiment comes from a very honest place. It aligns with a desire for quality and stability. However, from a perspective, it ignores the reality of systematic risk. Here's the hard truth that our S3 framework highlights. When interest rates rise violently, all bond prices fall. Not just the bad bonds, all of them. When a global recession hits, most stocks decline. It doesn't matter if the CEO is a genius. It doesn't matter if the product is essential. If the entire market, the system itself, is repricing risk, the good companies get pulled down right alongside the risky ones. Think of it like gravity. It doesn't matter if you drop a diamond or a rock, gravity pulls them both down. Systematic risk is the gravity of the financial markets. It is the price of admission for entering the economy. Now, this can sound intimidating. Words like systematic risk can feel heavy. But let's apply the SAFE principle here. This isn't about fear. It's about clarity. Once you accept that gravity exists, you don't panic. You just stop trying to float. You build a foundation that respects gravity. To help you navigate this legally and ally, we utilize a tool we call the Prime framework. This concept is derived from advanced financial designation curriculums, but true to our simple promise, we have translated it into everyday language. Prime is an acronym, PRIME. It stands for the 5 types of market storms that exist in the financial atmosphere. Let's walk through them one by one. P is for purchasing power risk. This is the silent killer we touched on in our last episode. Purchasing power risk is simply inflation. It is the risk that your future dollar will buy less than your current dollar. Many people view cash under the mattress or money in a standard checking account as safe. And in terms of the number on the statement, it is safe. The number doesn't go down, but in terms of value, it is extremely risky. If inflation is running at 3% or 4% and your money is earning 0%, you are systematically losing wealth every single day. From a safe, simple sound view, safety isn't just preserving the number, it's preserving your buying power. R is for reinvestment rate risk. This is often called the income trap, and it is a massive blind spot for retirees. Here's how it works. Imagine you buy a certificate of deposit, a CD that pays 5%. You feel great, you're getting a steady check, but that CD matures in 1 year. When it matures, you have to reinvest that money. But what if a year from now, interest rates have dropped to 2.5%? Suddenly, your income is cut in half. You didn't do anything wrong, you didn't lose the principal. But the environment changed. Your bills haven't changed, but your income has plummeted. That is reinvestment rate risk. The risk that you will have to reinvest your money at a lower return than you are getting today. I is for interest rate risk. This refers to the seesaw relationship between interest rates and bond prices. It is a law of finance. When interest rates go up, bond values go down. We saw a vivid example of this recently. Through our practice's observation of market patterns, we saw many conservative investors pile into safe long-term bonds in 2020 and 2021 because they wanted to avoid the stock market. But when interest rates spiked in 2022, those safe bonds crashed in value. That wasn't because the borrowers defaulted. It was purely systematic risk in action. M is for market risk. This is the storm everyone sees. The M stands for market risk. This includes wars, pandemics, elections, recessions, and geopolitical crises. This is the tide that lifts or lowers all boats. Most investors spend 90% of their time worrying about market risk. But in our S3 methodology, we recognize that while market risk is volatile, it is usually temporary. The other risks, like purchasing power risk, are often permanent. E is for exchange rate risk. Finally, E stands for exchange rate risk. If you invest globally, which our framework suggests is wise for diversification, the value of the US dollar versus the euro, the yen, or the pound impacts your returns. If the dollar gets stronger, your international investments might look like they are worth less, even if the companies are doing well. This isn't bad, it's just a variable. It is a systematic factor you must accept as part of a global economy. So that is the prime framework: purchasing power, reinvestment, interest rate, market, and exchange. These are the winds and waves. You cannot stop them, but you can prepare for them. Now, listing these risks is one thing. Seeing how they play out in a family's life is another. To illustrate this principle of systematic risk and the prime framework, let me share a hypothetical scenario. While this story is fictional and created for educational purposes, it demonstrates patterns we frequently observe when families attempt to navigate retirement planning without a systematic framework. Let's introduce a fictional couple, Robert and Martha. Robert and Martha are in their mid-60s. They have just retired. Throughout their careers, they were diligent savers. However, they carry a deep-seated fear of the stock market. They remember the dot-com crash, and they remember 2008. They have told themselves, "We cannot afford to lose money at this stage." Because of this fear, Robert and Martha decide to eliminate market risk, the M in our prime framework. They sell all their stocks. They want total safety. They look at the current economic environment. Let's say this hypothetical scenario takes place during a period where interest rates are decent, perhaps around 5%. They decide to put their entire nest egg into one-year CDs and short-term savings accounts. They feel an immense sense of relief. They look at their statement, and the balance is stable. They feel they have achieved the SafeSimpleSound ideal of safe. But let's look at this through the lens of our framework. Have they actually eliminated risk? No. They have simply exchanged one risk for another. Fast forward 2 years in our fictional story. The economy slows down. The Federal Reserve, in an effort to stimulate growth, slashes interest rates. Suddenly, the rates on those CDs drop from 5% down to 1%. Robert and Martha receive a renewal notice. Their income, which was comfortably covering their expenses, has just dropped by 80%. This is reinvestment rate risk, the R in prime. Because they were relying on short-term instruments, they were exposed to the risk of rates dropping. Simultaneously, let's imagine that during those 2 years, the cost of healthcare and groceries continued to rise by 3% or 4% a year. This is purchasing power risk, the P in prime. So now, Robert and Martha are in a bind. Their income has collapsed because of falling rates, and their expenses have risen because of inflation. They avoided the storm of the stock market, but they sailed directly into the fog of inflation and the drought of low yields. While Robert and Martha's story is fictional, it demonstrates a critical pattern. In our SafeSimpleSound practice, we often see that when people try to avoid volatility, the ups and downs, they often accidentally embrace fragility, the risk of running out of money. Robert and Martha tried to control the weather. They tried to predict that rates would stay high and inflation would stay low. From a perspective, their portfolio was not sound. It was unbalanced. It was heavily weighted to protect against one letter of the prime framework market risk, while leaving the door wide open to others' purchasing power and reinvestment risk. This example shows us that there is no such thing as a risk-free investment. There is only risk shifting. When you move money from stocks to cash, you aren't removing risk. You are trading market risk for purchasing power risk. When you move money from short-term bonds to long-term bonds, you are trading reinvestment risk for interest rate risk. Whether you are facing this exact scenario or something similar, the lesson is the same. You cannot hide from the risks. You have to manage them. You have to coexist with them. So, if we cannot predict which storm is coming, and we cannot hide from them all, what is the solution? How do we apply safe, simple, sound thinking to this dilemma? The financial industry, the 24-hour news cycle, the trading apps, they sell you the lie that you can predict these storms. They shout, "Get out before the crash," or "Buy before the boom." They want you to believe that with enough data, you can dodge the raindrops. Through our framework development, we reject that premise. It is exhausting, and frankly, the data shows it is impossible to do consistently. Safe, Simple, Sound takes a time coexistence approach. We know the storms will come. We don't know when. We don't know which letter of the prime framework will be the dominant headline next year. Will it be inflation? Will it be a recession? Will it be interest rates? We don't know, and we don't need to know. Instead of trying to predict the weather, we construct portfolios that act like the ark. We build a structure that can remain standing whether it rains or shines. This means we don't try to dodge the raindrops. We wear a raincoat. Practically, this looks like resolving the contradiction between I want growth and I hate volatility. In a financial plan, we acknowledge that you can have both, provided you accept a trade-off. You accept that volatility is the toll you pay on the road to growth. We might use equity stocks to fight purchasing power risk over the long term, acknowledging that they will be bumpy in the short term. We might use fixed income bonds to provide stability during market corrections, acknowledging that they face interest rate risk. We might use cash for immediate needs to avoid market risk, acknowledging that it suffers from inflation risk. By blending these together in a systematic way, what we call time coexistence, we ensure that no single storm can sink the ship. If market risk hits, your bonds and cash provide stability. If inflation hits, your equities provide the growth to keep up. This is what we mean by sound planning. It isn't about guessing right, it is about endurance. It is about building a plan that allows you to stay in your seat, confident that your ark is built to handle the waves, no matter how high they get. As we wrap up this episode on navigating systematic risk, let's summarize the key insights from our blog post and today's discussion. 1. You are the captain, not the weatherman. You can control your hull, your habits, your plan, but you cannot control the storms, the economy. 2. Beware the stock picker's fallacy. Good companies still suffer from bad systematic risks. Do not confuse quality with immunity. 3. Use the prime framework. Remember the 5 storms: purchasing power, reinvestment rate, interest rate, market, and exchange rate. 4. Embrace endurance. Stop trying to predict. Start building a portfolio that can coexist with whatever the market throws at you. You cannot stop the Federal Reserve from changing rates. You cannot stop inflation, but you can audit your portfolio to see exactly how exposed you are to each of these forces. Most people we meet in our practice are protecting themselves from the wrong storm. They are like Robert and Martha in our hypothetical story, wearing a life vest to protect against drowning while dying of thirst because they didn't pack water. They are overprotecting against market crashes and underprotecting against inflation or income loss. This episode draws directly from our recent blog post, The Storms You Can't Control, which you can find at SafeSimpleSound.com. To help you apply this systematically, we have created a specific resource mentioned in the blog, the Prime Systematic Risk Checklist. This is a simple yes-no audit designed to help you identify which of the 5 invisible storms is currently threatening your financial house and how to prepare for it. You can download it directly from the show notes or the blog post. If today's S3 insights resonate with your family situation, if you realized you might be focusing too much on the storms and not enough on the arc, we invite you to explore what financial planning could look like through our Safe, Simple Sound practice. But either way, whether you engage with our team or not, you are now equipped with the Prime capability. You have the language to name the storms and the framework to understand that safety isn't the absence of rain, it's having a sound shelter. Thank you for listening to the Safe Simple Sound podcast. We look forward to being with you again as we continue to help you navigate your financial journey with safety, simplicity, and soundness.